Everybody, this is Rob Keynes with goldsilverpros.com, and this is the weekly market wrap. I'm recording this on December 9th, 2022, about 9 in the morning, as the markets have just gotten opened up, and there's a lot to talk about here. Gold price at the moment is trading at 1793.57. It's up $4.33 on the day. Silver is trading at $23.18, up about 8 cents on the day. Silver has broken through critical resistance at 22 or 22.50, depending on which technical pattern you're trading. And it's been that way most of the week. So it's a good sign to see silver sitting at above 23 and looks like it may end the week there. We'll have to see what goes on the rest of today, but definitely bullish breakout sign for silver. And we'll watch at the end of the year and see what happens. In gold, 1793, we had eclipsed a critical $1,800 support line with gold, but the good thing is we're staying near that $1,800 line, which is good. Gold really hasn't stayed above its 50 and 200-day moving averages for any length of time, so we'll have to see what goes on in gold, but it's very positive for the metals that they're both up this week. The rest of the markets are basically down today. As I'm reading the markets, the Dow Jones Industrial Average is down 100 points, or 0.3%. The S&P 500 is down 7 points, or 0.2%. NASDAQ is down 23 points, which is 0.2%, and the Russell down 3 points, down 0.2%. You'll notice all the markets seem to move in tandem, and I believe that's because most of them are traded through algorithms and computer software and collective thought or groupthink by the market. But sometimes they'll break away and do different things, and we'll cover that on the program when we get there. Getting into the cryptocurrencies, Bitcoin's going to end the week up if the trend persists. It's 17,159.68 now, down $47 on early trading. Ethereum is down $5.74 to 1273.74. On the bond side of things, we still have elevated interest rates and yield curve inversion. The 2-year sitting at 4.334%, the 10-year at 3.558. Overall, both bond rates are up slightly on the day, less than 1%, but both are relatively unchanged from where they've been. All of the shorter term issuances than the 10-year are in backwardation with the 10-year, meaning they're priced above the 10-year, which says that the market expects more risk in the short term than the long term, which is a good recession indicator, which is why we talk about it. Overall this week, actually pretty positive for the economy, although only slightly so. The U.S. Services PMI Index is a purchasing manager index, which is a measure of hope. It's a sentiment index, closed exactly where the economists thought it would at 46.2. It's slightly over last month of 46.1. So at least we're holding steady there with regards to how purchasing managers across the economy, and those are people that buy stuff for their companies to make stuff, that they're seeing this as relatively okay during the last quarter of the year in which the consumer does most of their shopping. So that's a positive sign. The actual ISM Services Index itself traded at 56.5. That's above 50, so it's a positive growth number, and it's above expectations of 53.7, and it's above what we saw last month of 54.4. Again, a nice thing to happen. Factory orders are up 0.3% last month, 1% this month, so a gain and above economists' expectations of 0.7%. So again, all signs rosy there on the economy. Productivity revision, it was up 0.8% above the economist's expectation of 0.7. Unit labor costs, or what it takes basically for labor to produce something, is up 2.4%. It's less than the expected 3.5, which could be positive or negative depending on how you look at it. It does mean less costs, employment costs in the economy, but also means that wages are not keeping up with inflation, which is going to hurt the worker and therefore the consumer. We'll have to see how that trend continues throughout the rest of next year. Consumer credit use, 27 billion, which is a very high number, higher than the 26 billion forecast. And it just means that consumers are using credit to buy stuff. They don't have a lot of free cash. And we're going to watch that number very closely. It's been elevated here the last 4 or 5 months. We're going to see if it continues to be elevated. Is it just prep for the holiday season and all the spending that consumers do in the last quarter of the year? Or will we see that consumer credit levels bleed over in 2023? We'll be watching that. Initial jobless claims came in at 230,000, same as expectation, slightly higher than last month at 225. And continuing jobless claims still elevated, 1.67 million this month. Last month it was 1.61 million. So overall, the economy is doing okay in terms of orders and in terms of purchases, not as well in terms of employment and or wages. So as employment or wages are slightly negative, that will affect overall gross domestic product. in sales, and we'll track that as the month goes on. Now we're going to switch gears and get into the metals part of the program. So we'll be sharing you the data from the CME Group, and we're going to be going over what's happening in the gold futures market. The futures market is where the spot price is determined, and the last trade on COMEX is 1805.80. So more than the actual gold price, which is good. It means we're probably up on the day, about $4 up on the day on light volume. You notice here we have very light volume. So we know it's not going to be a heavy selling day, because usually heavy selling days come when you have heavier volume. That's 99% of the time the pattern. You can have heavy selling days on light volume, but it's very rare. Usually you got to get a bunch of extra paper dumped in on that market to get those prices to move down. February 2023 is now very clearly the dominant contract for gold. It is no longer December. So this is where we'll see most of our deliveries. Of course, we did have 78 deliveries on gold in the December contract on the strength of 6,500 contracts. Not a lot there. The majority of the trade here you can see is in February. 358,000 contracts yesterday were trading on the market, and overall 2,773 exchange for physicals. I call out the exchange for physicals because that's where you take a contract from COMEX and you go over to London and either demand the physical metal or play price arbitrage with the differences in price, meaning people are going to get either higher prices or the physical from London. And that's just basically what that means. This is Thursday's data. If we drop down to Wednesday's data, these are daily snapshots. You can see that on Wednesday, we had 2,152 contracts of gold delivered on trade of 356,000. And we're going to go over here to settlements and see where the price is trading at and why. So again, February is a dominant futures contract month for gold, and we settled down as of yesterday's data. This is Thursday, the 8th of December, up $3.50 on the trade overall on all the contracts to close at 1801.50. If you go back and look at Wednesday's data, you see that we settled at 1798, up $15 from the day previous on 158,000 contracts. You simply can go here and follow that information, and it tells you exactly what the trade is on the CME Group's website, and it will tell you what the spot price will be, because it is in fact that trade that determines the spot price. Now we move over to the London market and we look at the ETFs. The exchange traded products are also called ETPs, if you will. These exchange traded products are ETN and ETFs that store metal. Most of the ones listed here on this chart at Gold Charts R Us are going to be the ETFs. Most of them store the majority of their metal in the UK, although there are exceptions. For example, part of the GLD run by SPDR is stored in New York as well, although it's a minority of the metal. It also has a COMEX number, so we can see a 4-week trend on the COMEX. We've seen about 1.3 million ounces come off of the COMEX overall, out of 1.148, which has come off of the entire complex, which actually means we've had some movement back into the ETF. In terms of gold, if we look at GLT's chart specifically, we've had a nice runoff in gold stocks. We had that in 2013 to 2015, and then it rose twice, and we've had it since 2019 to now. So the trend is to take the metal out of the ETF. So the ETFs have less and less metal. And overall, over the last 4 weeks, you've seen over 1 million ounces go into the market from either the COMEX or the London markets. Moving over to silver futures, we're here. We see relatively light volume as well. This market is much like gold right now, not a lot of selling pressure. And if we look at the trades, the dominant month for silver is March. It's not February. It's different than gold. That means most of the trades will come on that contract. You can see here only 1,800 contracts left in December, and about roughly the same in January, which is not a heavy trading month. Only 19 deliveries as of Thursday's data. If we look back to Wednesday, we had 31 deliveries. Look back to Tuesday, we had 139. So silver is a more lightly delivered market right now than gold is. People are more interested in taking gold deliveries. There are 107,000 contracts traded yesterday on that March contract. If we go over to the settlement data, we can look and see what's happening. This is Thursday's data of settlements, where we see the prices they actually settled at on the March contract. We can see there was a healthy 45,453 volume of closed contracts. They settled an average of $23.25, and that was up 32 cents on the day. A nice positive day for silver. On Wednesday, another positive day for silver, up about 59 cents on trade of 52,476 contracts to settle at 22,922. We go back to Tuesday, it was down 68 cents, selling at 22.25 on volume of 50,269 contracts. Again, silver's basically moving sideways. Nothing big going on in silver. On the derivative markets, what about physical? Let's look at physical. Well, in COMEX, you've had a net influx into COMEX of silver over the last 4 weeks of about 200, 300,000 ounces. That's not what we expected to see, but nonetheless, that's what's happened, and that's because of recent flows. Some silver starting to come back into the COMEX. Overall, we've had a net increase the last 4 weeks of 5.5 million ounces of silver when you consider the flows are also into the ETF. So silver starting to come back in. You saw a little bit of an uptick right there with silver coming back into SLV. This is SLV, silver ounces held, although the trend is decidedly negative dating back to silver squeeze. It's interesting to note some's coming back in the market. Why is that? Well, prices are elevated. You're sitting here trading $23 silver, so anybody who might have bought it for less than that wants to reap a little bit of profit is going to put some silver back in the market, although that movement is much smaller than the movement out. So I'm not calling a reversal. It's nowhere near a reversal. It's just some silver coming into the market at higher prices, and it kind of gives us an idea of how much silver may come back into the market at higher prices. We're sitting at $4 higher silver than we were not too long ago, and you see an additional 5.5 million ounces come in. Now that's nothing next to what the supply deficit is for the year. The Silver Institute has revised that in their interim report here in November that we're going to be 195 million ounces short in 2022. So this 5 million ounces coming back in is a drop in the bucket. I still think we're going to have shortages, but at least some people are releasing some silver at higher prices, and this gives us an idea for what the overall liquidity is. When in a month, silver price moves up $3 to $4, we get an extra 5 million ounces. That'll be a good litmus test or an A/B test to see what will happen when silver hits 25, 28, 30. How much of that silver is going to be free at those prices come back into the market? That's what silver investors want to know. The more that comes back in the market, the more supply there's going to be, the less overall upward price pressure there's going to be. So this is good to see what could happen to the silver market as the price continues to rise. Now we're going to look at the commitment of traders reports for silver and for gold. Nothing too much going on here. This is data as of November 29th. Remember, this report lags behind by about 10 days. So the next couple of days, we should get the next one. Nothing major happening here. We see the swap dealers went more short. So the swap dealers in silver are taking almost an even position. They're at 40,122 contracts long. That's net long, about 3,000 contracts, because they're also short about 37,174 for a spread of about 3,000. Overall, they're about even. So this could mean that silver price is about even or only moves up slightly from here. We've had a nice pop to 23. Apparently, the bullion banks say that's good enough for now. It may drift down to the $21, $22 range or just stay even. But that's what I see the swap dealers basically taking bets as to they think that this is a nice little resting spot for silver right now at $23. And we're going to see if they're right, whether that goes long or just kind of sits here for a little while. The managed money is decidedly long. They were short until very recently. I think they're watching my videos because I keep telling them they're the dumb money when it comes to precious metals because, well, they are. They almost always lose money on the trades. They're smart with other things, not the metals. And I tell them that if you go short, you're going to be basically the dupe to the swap dealers going long. And so they listened, and now they're long 36,960 contracts. The other reporters are also long. So I think a lot of the financial and the smart money on the market is aligning long silver. And it's just producer merchants going short, most of them to hedge their downside silver price risk. So they're going to stay there. So this looks like a regular market to me. It looks like people are going long based upon silver shortage information where they should be. And the merchants are staying short and the producers because they get to hedge their downside price risk. This to me looks like a normal commitment of traders report, much different than what we've had in silver for the last 10 years, where there was rampant short positioning by 4 to 8 swap dealers. That's no longer the case, and it seems like all the smart money's lining up to take silver long, and it looks like a healthy silver market, a healthy setup for a long silver move in 2023. This is what I see. Now moving over to gold and the commitment of traders report, and gold they're still net short almost by half or almost double. 181,577 short positions, only 98,970 long positions. Although you see here they did drop almost 5,000 shorts and add almost 2,000 longs. That's been the trend. So slowly but surely, the shark money, the sharks of the market are moving long in gold, although they're not there yet, which tells me the move in gold's not going to come yet. You still got almost twice as much, maybe 90% of additional downside pressure from the swap dealers. So I don't see gold popping right now. I think silver has much more upside potential right now, but I think gold is moving that direction. And that tells me sometime in 2023 or 2024, the bullion banks are going to go long gold. And that's probably where you're going to get your big historic move in the gold and silver markets. Could start as early this year. We'll continue to watch the technical positioning on the on the market through the CFTC commitment of traders report and let you know what's going on. The managed money is now net long gold, so they're expecting to go long. The other reportables, which are the family offices and the smart wealthy individuals are long by a factor of almost 5-1 on gold. And of course, the producer merchants are short because they're hedging downward price risk, which they have to because they deal in the middle every day. All of that makes sense. So what is my overall impression? Overall, the economy had a middle of the road week. You had some persistent joblessness. You had some persistency downward in the real estate markets, but overall in the production area and the purchasing managers, what they're seeing is a slight uptick. I attribute that to the fourth quarter uptick that you get when you have all the Black Friday sales and all the consumer sales coming in. It's basically where a lot of people go black for the year, hence called Black Friday, the retailers, because they make a lot of their sales at this time of year. Maybe, additional 25, 50% over what they see, sometimes double, and it brings them into the black. And you're starting to see that in the numbers. You're seeing a little bit of an uptick, although not quite what I would have expected. It's very modest. So we're going to track that over the next couple of months to see how well we did the last quarter of the year. It's possible we could salvage this year with a positive GDP and just positive messages overall if we have a strong fourth quarter and the consumer comes in. If we don't, that could be an indication that 2023 could be a lot bumpier. Certainly, a lot of the banks have come out, Bank of America, Goldman Sachs, and some others predicting that 2023 would be very rocky, and we'll have to see what happens there. That could be very prescient calls, but they're doing that based on what they see in the fundamentals. However, for right now, the economic data looks okay. The gold and silver has had a nice pop on weaknesses in the crypto market and weaknesses in the broader market, and on expectations of further Fed rate hikes, although what the Fed announces next year will be key to what happens to gold and silver, and we will follow that. Of course, all of that is in our weekly reports, which we do for the whole purpose of letting you know what was the major things happened last week, what are the things we think are going to happen this week, where all the data is, and so you're prepared for your trading week, listening to this for 15 to 20 short minutes every week, and that's why we have it there for you, all compressed into a quick, easy report. As a reminder, we also do this on podcasts, so you can get us on Anchor, Google, Apple, or wherever you find podcasts. We just found out that Gold Silver Pros in a few short months has ascended to the top 5% of most recommended podcasts and most listened to podcasts on Spotify. And we thank you for that. You, the listener, have been a big part of our success there, and we do appreciate that. This will be on that, by the way. All the content we put out in video form, we also put in audio form on the podcast. In case you don't have time to listen, you can get us over there on your way to work or on your favorite podcast streaming application. Thank you so much for tuning in. Hope you guys have a blessed weekend. We'll be back more next week with more content, as we always are. This is Rob Kientz reporting for Gold Silver Pros. And for JM Bullion, if you're staying on the Gold Silver Pros channel, stay tuned for the weekly metals report coming up next.